So if this were a large cap index, then a rupee invested in it every month since 2007 would have given me a return of 12.8%. But if instead we had invested that money in a small cap index, then it would have fared a little better and given me a return of 13.8%. But let's say I were to combine these two indices. So we have a little bit of large caps and we have a little bit of small caps. And then let's see how the magic goes. Not very tasty, but what is really good about this mixture of large caps and small caps that it has given us a delicious return of 16.3%, which is a lot higher than the large caps and the small caps in isolation. And so in this video, I shall take you through some simple steps of how anyone can achieve that extra 2 to 3% on one's capital. Let's begin. External events and their perception play a big part in determining investor interest, which means investors who preferred large caps during the uncertain years of 2009, 2013 and 2020 were pretty much the same guys who were dominantly invested in small caps in 2007 and 2017. This probably explains why a relative valuation range of 0.9 to 1.1 becomes an important stock picking trigger and how it can be used to our advantage. The first step in developing a model is to collect the month closing values of the Nifty 50 and the Nifty Small Cap 250 index. You can do this by going to the NSE India website, click on products, then on equities. To the right, I see a link that reads historical index data. I then click on total returns index value, then select the index from the drop down. I enter the time period for which I need the data, and that's it. The daily index values will be displayed on the screen. Now these are daily values, so converting it into monthly numbers will take some effort. But to help out, I've compiled the monthly Nifty 50 and Small Cap 250 closing values for the last 15 years in a Google Sheet, which you can access via the link that I've added in the video's description. Actually, this Google Sheet is a bit important because it also consists the different scenarios we'll be discussing in the rest of this video. Alright, now that the data is ready, let's look at some investing scenarios, starting with the most common one, that is, how did the Nifty 50 TRI and the Nifty Small Cap 250 TRI perform individually over these past 15 years. So on the Google Sheet, we go to the scenario 1 cell, and using the XIRR formula, we arrive at an annualized return of 12.8% for the Nifty 50 TRI and a CAGR of 13.8% for the Nifty Small Cap 250 TRI. In numbers, a 10,000 rupee monthly SIP over this time period would have grown to 55.5 lakhs when investing in the Nifty 50 and a little over 60 lakhs in the Small Cap 250 index. But now let's put in some guardrails, some conditions in our study and see what happens. For instance, the upper limit of 1.1 indicates a level where the small caps are overvalued or a lot more expensive as compared to large caps. So one of the more straightforward action I can take is to pause my SIPs in those months where the 1.1 limit is getting breached. For scenario 2 in our Google Sheet, this exclusion comes to 23 months. And because there is no capital invested in those expensive 23 months, the percentage performance of scenario 2 shows a slight improvement with annualized returns of 14.1%. I know what you're thinking. You're saying an extra 0.3% returns is not really good enough, and I kind of agree with you. So let's see what more can we do. Something simple that can be done is to not just pause SIPs, but we can also choose to redeem or sell them when small caps are expensive. For instance, if I start selling 10,000 rupees worth of units every time the small cap level crosses 1.1, then my portfolio would receive an additional 0.3% lift, taking my annual return to 14.4%. Yet another scenario one can look at is where we not only sell when the small caps are expensive, but we also buy when small caps are relatively cheaper. In fact, let's double down on this. So in this new scenario, when the relative line crosses the 1.1 level, we sell 10,000 rupees worth of units. But when the number crosses 1.15, we sell an additional 10,000, that is 20,000 rupees worth of units. and at the 1.2 mark, we redeem a total of 30,000 rupees of small cap units. At the other end of the spectrum, if the number goes below the 0.9 mark, then we invest an additional 10,000 rupees. At the 0.85 level, we put in an additional 20,000, and at the 0.8 mark, we invest an additional 30,000 rupees over and above the regular 10,000 rupee monthly investment we are anyways making in the Nifty Small Cap 250 index. By doing this, we are not only determining the action we need to take, that is to buy or sell at different levels of relative valuation, but we are also defining the quantum or the amount of action, which in our case is the redemption or an additional investment of 10,000, 20,000 or 30,000 rupees. But the big question is this tactical buying and selling strategy really worth your time? Well, we find the answer to this question in our Google sheet, and it's a compelling yes, as this strategy has delivered an impressive 16.3% in annual return. Remember, we started with a 12.8% and a 13.8% CAGR for the Nifty 50 TRI and the Nifty Small Cap 250 TRI. So 16.3% is a massive jump from that perspective. But having said this, there are some additional elements that one would definitely need to consider. The first is taxes, and seriously, there is no escaping that. But given the fact that a larger portion of capital gains will be long term and there is just a 5% difference between STCG and LTCG, I for one will not bother much about it. A second consideration is liquidity, and if you don't have the money to invest that additional 10,000, 20,000, 30,000 rupees, there might be some slippages which you'll need to live with. But here's a thought. So if small caps are relatively inexpensive at 1.1, 1.2 levels, then it also means that the large caps are relatively cheap at those same points of time, which essentially opens up a long short opportunity, allowing us to buy units in a Nifty 50 index fund at the same time when we are redeeming units in the small cap 250 fund. This relative valuation driven approach not only gives us a respectable return of 16% over a 15-year time period, but by generally remaining invested in the market, it also helps us accumulate a bigger portfolio corpus. So we've gone through 5 scenarios in this video. We looked at the Nifty 50 TRI and the Nifty Small Cap 250 TRI in isolation. We then put a pause on SIPs which were in the expensive zone. Scenario 3 is where we didn't just hold those SIPs, but we sold them. The next one was the buy low, sell high scenario. And the final scenario is where we use the redemption money from small caps to invest it back in large caps during periods when they were a lot cheaper. To sum it up, it is my belief that small cap investing is a lot tactical when compared to investing in large caps and even mid caps. And while I advocate the use of SIPs even in small caps, I sincerely think one can take the fullest advantage of its volatility to maximize performance, as we saw in this video. If you found this presentation useful, then do share this video with your friends and help me grow this channel. Thank you for your time, and I look forward to catching up with you soon. Until then.